Hello, I'm Philip Stoughton. I'm at Apex 2015 and I'm joined by Charlie Barnhart of Charlie Barnhart and Associates.
Hey,
Charlie,
Phil.
great to see you again.
Good to see you.
What I wanted to explore with you was kind of what's going on in the market in terms of geographies. Constantly hearing of new regions. We were at the Zona facility opening in Costa Rica. A lot of people talking about Vietnam.
Yeah.
What are you seeing overall in terms of movement in the big picture?
Well, I think underlying the, I'll give my observations on the movement. Let me let's lay some baseline stuff down relative to where everybody's at today, because it's really influencing that, how things are shifting around. So as you know, I mean, everybody knows, if you look at the major regions around the world, starting with Europe, Europe's having a tough time. We're still fighting sovereign debt issues. The growth rates are anemic at best, right? And some of the places, some are still strong, and I'm sure you saw some of the recent stuff, and I see all the data. There's some good Eastern European solutions that are strengthening and stuff. Some of them are falling off, but so we still need to reconcile these issues in Europe. But I think it'll work out. I think we're 3 or 5 years out from a major economic recovery, but that's where we're at there. So that's one of the regions that's probably not getting as much focus as it should. I think so, because of these issues. The next one is, of course, in North America. So the NAFTA countries, Canada, United States, Mexico, they're enjoying a renaissance. We have seen finally, repatriation of a lot of work back into this region. Canada is doing better than I really expected over the last 2 years. I've been working with a lot of folks up there, and I saw a number of projects that I really didn't think would go into Canada that did. And so that was good. That was positive. U.S. is doing reasonably good. The growth rates are not fantastic, but they are what they are, mid-single digits, or maybe just a little bit lower than that. Mexico is still expanding. There's a lot of interest. I've been spending a lot of time in Mexico, and so there's a lot of new stuff going on. Some of them are sheltered organizations, some of them are foreign subsidiary operations. But I think that's going to continue for at least the next 3 or 4 or 5 years and grow, and that's the area that I see the largest growth in right now. And then if we shift over to Asia, the problems are varied and many. Some geographies are better off, some are still in their expansionary kind of structures, but there's some problems. There's some problems, and when you look at it overall as an area, it looks more like a meltdown situation than it does into a restructuring kind of thing. So I think some of these operations, some of these geographies and some of the operations embedded in them are really going to be shifted out.
Right.
And so a classic case, and I haven't been able to get on a plane and go recently, but Thailand, there's something going on, something wrong with Thailand right now. Thailand has, at least in our industry, has a negative growth rate right now. And so there's more work coming out of Thailand than is going into it. And Thailand has a lot of great solutions. There's a lot of good manufacturing space in Thailand. So the question is, what the heck's going on there, right? And other locations. We talked just a little bit ago about Vietnam. Vietnam's a potentially emerging location, but it's a relatively small country, fairly small population, lacks significant infrastructure. But some of the people have gone in, have been reasonably successful, and they've been contributory to the development of the infrastructure in the country, and I think that's a good thing. But long term, it's not going to be another China.
No.
But the Philippines and Indonesia potentially could be.
Yeah, there are some nice companies down there doing some decent stuff. IMI, for example, I like the way they've been growing. So what about the elephant in that region, China itself? What do you see going on there? I've been talking to people that are very well connected to government there, and there seems to be this thing where they're saying, okay, well, we're happy to let some of the real low value, high volume stuff go. And I'm thinking, I've seen this movie before, and it doesn't end well. That's right, doesn't end well.
So I think that China came up so fast and was impacted so fast by the tributary factors of that rapid growth, right? Inflation and employment issues and all those kinds of things. It needs to be reconciled out. These guys are really good at what they do. Some of them, may not be at the quality levels that are compatible with the rest of the world, but a lot of them are. If you take the top 15 contract manufacturers in the world, or global service providers, as we both know, the majority of that work is there. You take Foxconn out, you've removed half the industry, right? Yeah. And so I think there's still great opportunity there. I think what's really going to happen, though, is the original ODMs that are in that top 15 of global manufacturing service providers are pretty much fed up with the manufacturing services industry. And my forecast, which I actually made here at the show, is we're going to see a couple of these people walk out of that kind of activity. We're going to walk away from it.
And do what?
Do their own products.
Okay.
So HTC, Lenovo's, exactly, that kind of stuff. They're going to follow after their big brothers.
The Huawei
Huawei's, exactly. That's a good one, But that's an inevitability. I mean, this trend has been on the table for quite a while. The cards were played. It was just a matter of what the whole cards were. And I think they're just about to flip them over. So there's going to be a big chunk of capacity go out of China. But I think that may actually make it a more stable place.
And sort of settle down the regionalization worldwide.
I think China's still a wonderful solution.
Yeah, absolutely, and I think it's
not for everybody, but
for the right
people.
And the right people, and again, it's got a growing consumer market, so there's a domestic market that's improving as well. So just stepping back, I mean, as I mentioned. Costa Rica, and we're here about different regions, different places like that. Without being specific to a region, if you were a contract manufacturer and you were looking to choose a region to manufacture, maybe one that doesn't have already some large players in, what are the key factors in making that decision? What makes a good manufacturing location?
So you need to... there's probably half a dozen items, but the big ones for me, are related to the society in which you're going to do this, and it's not just in a specific country, but in a region, that includes a bunch of people that kind of share a common culture. And so, if you look at, I think Western Europe again is a classic example in this. So you have a whole bunch of different, countries. And from a U.S. perspective, you got these little countries.
They're like states.
Like states, right? But they do share a common culture. They even have different languages, but they work together. It's the whole European Union kind of concept thing. But anyways, what you've got here is you've got countries that are highly developed infrastructures. They have embedded educational systems that are functional, right? They have rule of law. They have a banking that is consistent and transparent, right? They have stable governments. These are my big kind of issues. Big key factors. So it's easy. Business is challenging, but it's not impossible. You can go to anywhere and run a business. Clearly, the world knows this. But if you go to places that have these kind of attributes, it's a lot easier and a much higher probability of success for your business if you can rely on these things. International banking kind of relationships and all these other things I talked about. Stable governments. Currencies are always going to fluctuate. We're always going to bump around against each other because this, Spain is not real happy with France. Whatever it is,
it's been going on for 2,000 years.
For 2,000 years, but it works.
As
long as it works. If you know how the system works, you can work in the system. The problem I see, and the one that probably provides me more business at Charlie Barnhart Associates, is not these issues. It's the issues where people go into highly low probability locations and try to make a go of it. Right?
So those volatile.
So volatility. We have unstable governments. We lack rule of law. The banking system's corrupted or ineffective. Whatever. So, but they want to go there because they think this is going to be the next big area because you can get labor for 6 cents. So, if you want really, really low-cost labor, you go to sub-Saharan Africa. But is anybody going to do that?
No.
If they do it, they're foolish, right? Because it lacks all these requirements to run a business. But so we got to give up. I've been talking. Me and you have talked about this probably for 30 years or something, right? But we got to quit chasing low-cost labor. I looked at, for a friend of mine this morning, I looked at a quote that they're having quoted out there, out quoting. And the labor content on this particular assembly, beautiful assembly, very nicely done, is 4.6%.
Right.
4.6% of cost is in labor, and that includes the overhead.
Okay.
You know, so what are we doing here?
So who cares?
Yeah, it's $12,000 board, and you know, and 4.6% of that is labor. Is labor. Yeah.
So yeah, I think we do need to get past that situation and think about, you know, what really matters in terms of those locations. Do you think there is trend in terms of manufacturing excellence? Do you think regions are improving the way they manufacture and actually driving those labor costs down? We hear all this stuff in Germany about Industry 4.0 and mass automation or custom automation, different things, different trends, and I thought, my view was always that the OEMs were better at investing in that than the EMS guys, because the EMS guys have got these wafer thin margins.
No, that's true, yeah.
Is there anybody really driving manufacturing excellence to make us more efficient so we can manufacture in higher cost environments?
You know, I think that's on both sides. I agree with you on the OEMs. The OEMs are really embedded in this, you know, manufacturing 2.0, 3.0, 4.0, all this stuff. And there is a lot of new technologies, and there's a lot of control elements that have been added into the processes that we haven't seen before, you know. But the EMS industry too has also been bucking up on their equipment, on their engineering capabilities, both from a design and processing perspective. They're doing a lot more what I would call lab type work than they used to do.
Yeah.
So I think there's been a huge. In the last 10 years, there's been a huge increase in the capabilities of the manufacturing, and it's worldwide. It's pretty much everywhere, not in any particular geography. The issue is that we're literally working on a 1% problem.
Yeah.
This isn't the problem. Technology and the ability to manufacture isn't the problem. The problem is the business relationship and the solution is broken.
Yeah. Which you have been saying for 30
years.
For
a long time.
And they haven't fixed it yet.
They haven't fixed it.
Yeah.
And so what we have is, you know, we have the outsourcing dividend with the consumer, right? Yeah. And we have the escalating costs of production from the producer. And at some point, we need to fix that basic business issue. That's the problem. It's not the technology. Technology is, this industry, all of us worldwide, is so good it's almost incomprehensible. Yeah. I remember when I was a young engineer, right? Yields were measured in, you know, whether good yield was 60-65%. Yeah. Today, it's a fraction of a percent.
Per million, isn't it?
It's parts per million. I mean, it's you know, we don't talk about. We achieved a 65% yield on this.
You'd be in a lot of trouble.
Yeah, you'd be in a lot of trouble. You wouldn't have a job, right? You wouldn't have a job if you had a 96% yield, right?
Yeah.
So the industry does a good job, and what we got to do is we got to fix the relationship between the parties. That's where it's broken.
Yeah. Last question. Yeah. I look at a lot of the big tier ones, and you talk about maybe some of the Chinese ones moving out of EMS and drifting through towards the OEM path. But what I see concern some of the larger guys is they're trying to get their stock cap up, and they have a very low multiplier, and the industry is seen to have that low multiplier. How do they shift that? Is there a way that they can shift that, or do they have to become an OEM to do that?
Yeah, no. Well, I think there's a couple. That's a really big deal. I mean, that's the 900-pound gorilla in the room. This issue, but they're you know what their valuations are, especially these big contractors. There's a couple things that come out of these low valuations. One is they're really you look at what their capabilities are, and then you look at what their valuation is on the public market, and it's like you could buy these companies for less than the value of their equipment in some cases, right? Yeah. And so this is almost become an inevitability. And yesterday here again at the show, I talked about what I thought might happen over the next 3 to 5 years. And one of my forecasts is that I think there's a number, I don't just think this, but I believe, because I've talked to so many people, that there's a number of people out shopping for these big solutions right now. And what they're going to do is they're going to bring them back in-house.
Right.
Yeah, because about half of the senior executives that I talked to today, what we talk about, this is their OEM executives, is about bringing stuff back in-house, at least some portion of it.
Okay.
Yeah, to control it, because they really feel overly dependent, and they know that the relationships are deeply damaged and flawed, right? And they're adversarial at this point. So that's what makes them nervous. So that's one of the things. When we talk about when we talk about other elements of the business itself, the real solution, if forget about the OEM for a second, the real solution for an EMS company is diversification of revenue.
Yeah.
And so there's all kinds of ways to diversify their revenue stream, and they've been working on this for a long time. Some of them have invested huge amounts of money in this.
Yeah.
The problem is it just hasn't done very much for them. So if you're working on razor-thin margins here, you really can't diversify 5 or 6 or 7% of your revenue and expect to achieve any results. You've got to diversify half your revenue into a much higher level.
And often they're diversifying their revenue into areas and pushing the margins down in those areas.
Yeah,
as well,
exactly.
Which is
and so they have to find ways to diversify their revenue, and not 5 or 6 or 7%, but 40 or 50 or 60% of their revenue.
Yeah.
Because they're in a commodity business. You know, building printed circuit board assemblies and boxes is a commodity business. There's nothing wrong with being a commodity manufacturer. Alcoa has made a hell of a career of doing it in aluminum, right? But also Alcoa is a highly diversified, you know, a company.
Portfolio,
And so these companies need to, you know, take that model and think about it. They're not going to survive if they don't do something.
And they've got to do something different. Because they look at an Uber or something that's got a valuation of $40 billion and think, what are we doing wrong? It's kind of weird.
What are we doing? We're sharing each other's car, and they make $40 billion.
It's crazy. Charlie, pleasure to see you. Great insight. Thank you very much.
Thank you very much. Always a pleasure.
Thank you.